Companies Hitting a Home Run with Home Mortgages webinar. My name is Leanne Case, and I'm the Marketing Director for CU Companies. While I'm your presenter today, there were several others that contributed content and research to today's webinar, and I'd like to acknowledge them. There's Stacy Garrity. She is our broker and manager for CU Realty, our real estate business unit. And then Kayla Hinseth is our communications coordinator, and Greg Shatsky is our sales and digital marketing coordinator, and they're both on the marketing team with myself. Today's webinar is a 10-minute format. It's kind of like speed dating. We're going to get you in and get you out. We know that you're really busy, so our intent is to give you a quick snapshot for you to take back to your teams and then digest it and continue the thought process. So the agenda for today is we're going to take in our 10 minutes. We're going to look at what's happening in the housing market, why you care, what CU Companies is seeing and hearing, and then what you can do about it. Today's information is actually contained in our new white paper, which launched a month ago, and as an attendee, Kayla will be emailing it out to you after our visit today. So let's get started. Here's what's happening. The U.S. economy is actually continuing to rebound, which means that your lending portfolios are positioned for significant expansion this year. And that's going to continue off of the momentum from last year. So here's where the state of housing is specifically. Reuters is telling us that the U.S. home ownership fell to a 20-year low in the fourth quarter of last year, but a sharp rebound, there is a sharp rebound in the rate at which Americans are setting up home. So that's also going to pick up housing. They're telling us that household formation quadrupled between 2013 and 2014. So what that means is young adults were previously living with their parents, but then they were enticed by the mortgage rates and then loosening credit means. So a lot of them are deciding to get out on their own. What we're also learning in the state of housing is that there's a strengthening in the labor market. So that, again, the housing is expected to regain momentum this year. And what the economists are telling us is that they believe that home ownership rate will start to stabilize in the coming quarters. So consumers are really going to be looking to you now to get their dream homes. So why do we care about all that information? Well, we know that building a strong mortgage program does more than just expand your lending portfolio. It actually deepens the borrower relationships, your borrower relationships, and boosts your profitability. So in a study that CU Companies conducted, we found that the average household balance is $67,000, a little over $67,000 for a household that has a mortgage, compared with just $16,000 for a household that does not have a mortgage. That's a 320% difference. As part of that study that we did, we found that households with mortgages actually have a higher cross-sell ratio. Those households are carrying 2.75 products, whereas households without a mortgage are only 1.98, and so that's a 38.9, almost 39% difference. And then finally, we found that households with a mortgage are delivering you a profitability of $938. So in the terms of profitability, wallet share, and product usage, that's why we should care about what's happening in the market and be ready for it, because it definitely impacts in a positive way your bottom line. So here's what we're seeing. We see a lot of lending portfolios that are remaining overly focused on other products. Year over year, Callahan is showing us that new auto loans grew 21%. This is regarding your lending portfolios. New auto loans grew 21%, member business loans grew 14%, and used auto loans grew 13%, while first mortgages grew only a 9.2%. And again, that's according to Callahan and Associates. And yet our research has found that auto loan relationships often have lower profitability than first mortgage loan relationships, as I previously mentioned to you. So what CU Companies did is we worked with Marquee. They're an MCIF organization out of Dallas, Texas, and they do different marketing campaigns based on that MCIF information for credit unions and community banks. And their last campaign that they ran was for a $350 million in asset credit union that credit union received 160% ROI on their last auto loan campaign. That means they wrote 115 new auto loans. So when we looked at that from a household profitability perspective, we found that that relationship was actually costing the credit union $96. So I had Marquis take a look at borrowers in that same credit union that had a mortgage in addition to the auto loan, and their household profitability was actually a positive $1,402. Now I know that a lot of you on the webinar today don't portfolio your own mortgages. You're using correspondent or retail lending channels. We actually have a worksheet that we're working on developing to help you see the difference by using the correspondent and retail lending channel fees. And in our initial tests, we're finding that that profitability still exists even if you don't portfolio those mortgages. So moving on, we know that simply having a mortgage program isn't enough to capture that potential profitability of mortgage products. You need to invest in marketing of those programs. So we did another study, and we found that half of our owners and partners, they're citing a lack of mortgage marketing materials as a barrier to a successful campaign, which is why we have the marketing library available to you. We also found that mortgage communications were entirely absent from nearly 1 in 5 annual marketing plans at credit unions and community banks. Some of them were citing that lack of budget focus, which was really lack of strategy. Mortgage strategy is a reason why. Another reason is lack of staff education for cross-training, and then lack of data for targeting. So here's what we can do about it. I'm going to give you two real quick tactics. The first one is a loan officer calling program. This is a really great opportunity for your lenders to develop a great relationship with the borrowers. And we've developed 4 specific audiences that your marketing team can pull and deliver these to your lending team to make personal phone calls. And the first one is to look at your new accounts. People usually come in planning to open a car loan or get a car loan and open up a checking account. Don't let them go past 90 days without calling them about your mortgage program. So this one says 25 years and older and an account that just opened a product in the previous month. So you can make these calls on a monthly basis. And actually I wanted to sneak in here. We just received data that says 74% of 18 to 34-year-olds are planning to buy a home in the next 5 years. So you can even reduce that age of 25 down a little bit. The second group you can look at is take a look at your current mortgages. We're finding here at CU Companies, we're seeing the attrition at about the 4-year mark. So have your loan officers start calling them just prior to that 4-year mark or at the 4-year mark. A third group you can look at is your home equity accounts. Look at your lines of credit and your seconds, those that don't have a mortgage with you. They obviously already know you and love you, so having that mortgage conversation between the lender and the borrower would be an easy one. And then a final group is, this is actually based on some successful history in working with an MCIF program. Look to your borrowers that are aged 25 to 45 that have 2 other loan products with you, so a credit card and an auto loan. They also have deposits with you of $5,000 or more, and then dedupe out the home equities because we've already addressed those in that 3rd quadrant there. So this is a group that has a high propensity for taking out a mortgage with you. Again, using a loan officer calling program is a great relationship step with your borrowers. The second way to capture more mortgages is to do it through partnerships. Look to real estate agents. In fact, they can be really valuable partners for spreading the word about your mortgage program, whether it's new or very well established. We know that cultivating a realty partnership can be a great win all the way around because it provides the consumer with a connection to a trusted real estate agent, and then it provides you with lead generation opportunities for new mortgage business. We also know that there's a high percentage of home shoppers that will ask the agent for a mortgage loan referral. They want to know, where should I go, especially those first-time home buyers. So by having that real estate agent partnership, it can protect your mortgage relationship rather than letting that consumer go to the competition. I want to talk just a little bit more about the real estate partnership. You really want to start by finding a trusted real estate agent. Maybe they're already someone that is a customer or a member of yours, but you want to work with someone that's willing to serve as a partner that supports your mortgage program strategy and can be an advocate for the borrowers. So you really want to manage those expectations and so that they understand what their expectations are of you and what you are of them. One thing that I have up on your screen right now is a sample flyer that our team put together for one of our owners, which is Spire Federal Credit Union. They have a real estate partnership with Tim Tolis and Laura Tolis. What they wanted to do is deliver a flyer to their insurance partners so that when those insurance agents were talking to their clients, they could say, oh, by the way, you know, if you're in the market for a new home, we can do the loan and we can hook you up with some trusted real estate agents. So this is an example of something that an agent might expect by being a partner of yours. They might expect to do some co-marketing. So that was the second really quick tactic that we have for you. We know that strategic partnerships and ongoing targeted marketing efforts are only two ways that can ensure that you're strengthening your mortgage program and that are going to put you a cut above the competition. And as I conclude here, I would add that it is important to the success of programs like these, make sure that your staff are aware of these initiatives. Obviously, your lending team and your marketing team are going to be aware, but even other members of your frontline staff. We've seen greater success in our own real estate agent partnerships with our credit unions and community banks when the frontline staff understands how important this is and when they're given the opportunity to meet and get to know those partners. And then the second piece I would leave you with is to share the profitability information with your staff. Help them understand what products contribute to your bottom line and which don't, and what your strategy is around that, and what their independent role is in helping gain those profitability numbers. So with that, that was our quick 10-minute webinar. Hopefully that opened up some dialogue that you can have with your executive, marketing, and lending teams as to how mortgages can strengthen your profitability numbers and how you can up your mortgage marketing game. Thank you.